and I'll throw over to Adrian Bailey, who is principal in our Sydney office, amongst many other things, who's a great speaker and will take us through today's session. Thanks, Adrian.
Thanks, Paul, and thanks for the compliment. That's not what you said to me earlier while we were chatting before the webinar started. As Paul mentioned, today is the second of our series on trusts, and we're going to run through taxation of trusts and how trusts are taxed, as well as then obviously having a look at one of the key areas at this time of year for clients who have trusts, and having a look at resolutions and how to make them effective, particularly when we're looking at streaming things like capital gains and franked dividends. We are running another session on trusts next week, and then the following week after. The topic for next week, just so that you're aware, is going to be strategies for changing trust structures. So whether that's changing them for succession planning or for other reasons, as well as having a look at ways that we can further implement asset protection for trusts. So we know if you'd attended any of our earlier asset protection seminars, obviously we talk about trusts a lot in those. For the reason that they do provide a lot of asset protection, but if the trust itself is a trading entity and holds valuable assets, how can we further protect those? So that will be next week's session, the invites for which will be out later on today. But today, as I mentioned, we're going to have a look at the taxation of trusts and work through the relevant provisions of Division 6. So we are actually going to look through the sections so we can see why trusts are taxed the way that they are, and why some of the issues that you come across in practice arise. Have a look at the difference between net income or distributable income. Distributable income you may also know as trust law income, but have a look at what the difference between those and why there is a difference. And as I mentioned, having a look to make sure that we can stream capital gains and frank dividends effectively, as well as our resolutions overall. So jumping into Division 6 to begin with, that's the main provision or the main division within the Income Tax Assessment Act 1936 that deals with the taxation of trusts. First off is that the trustee is not generally liable except as provided in the Act. So there are provisions within the Act that make the trustee liable for tax, but the whole concept and the whole rationale behind trust taxation is that they are meant to be a flow-through entity, and it's the beneficiaries of the trust who are meant to pay the tax. Of course, the trustee themselves need to be a taxpayer in respect of the trust. So there is legislation which provides that, first off, they're generally not subject to tax. It's the beneficiaries who are subject to tax, and we'll go through the way that that works. But as I mentioned, there are some provisions which do subject the trustee to taxation. We won't cover them today, but normally that's when we have either an amount that hasn't been distributed from a trust to any beneficiary, or some other provisions such as some anti-avoidance provisions in Section 100A and other anti-avoidance provisions. The key provision within the 1936 Act is Section 97, which outlines how a beneficiary ends up being taxed from a trust. So I'll read through the actual section here. The parts that are in red and highlighted, they're there because we're going to go through each of those in separate slides as to what the meanings of those particular phrases are. And so Section 97 says that where a beneficiary of a trust estate who is not under any legal disability is presently entitled to a share of the income of the trust estate, and there's some further sections there which we've cut out for brevity, believe it or not, the assessable income of the beneficiary shall include so much of that share of the net income of the trust estate as is attributable to a period when the beneficiary was a resident. So obviously one of the first things in relation to this is dealing with beneficiaries who are not under a legal disability. So it's not dealing with minors or not dealing with people who can't legally receive the distribution. So it's really dealing with your run-of-the-mill distributions from trusts, and it's how trust beneficiaries are taxed. So the core concepts and core phrases that we're going to examine are this concept of presently entitled, what that means, what income of the trust estate has been found to be. That phrase, so much of that share, there's been a lot of court matters in relation to actually what that means. And net income of the trust estate. What is the net income of the trust estate? And again, most of the litigation and disputes in this area are around these phrases and what they actually mean and how they should be interpreted when we're dealing with the taxation of trusts. So presently entitled, believe it or not, is not defined within the Tax Act. It's a fairly core area or core concept, but it's not defined. When we're dealing with capital gains and franked dividends later, we'll see the concept as specifically entitled. That is defined within the Tax Act. But presently entitled is not defined within the Tax Act. So in order to come to a meaning of what it means, then we can turn to the cases and the interpretation by the courts of what they have decided presently entitled means. And probably the best example of that is the Federal Commissioner of Taxation and Harmer, where it says that presently entitled means that either the beneficiary, means that the beneficiary has an interest in the income which is both vested in interest and vested in possession, and the beneficiary has a present legal right to demand and receive payment of the income. There are some provisions within the Tax Act which can deem you to be presently entitled. So normally you will become presently entitled to income by a trustee making a distribution in your favour. So a distribution of income or a distribution of a capital gain. That's how in the normal run of things, most beneficiaries will become presently entitled. However, to take into account that sometimes people can try to be a little bit tricky in their affairs, there are some sections which deal with what you would consider to be deemed present entitlement. The first of those is section 101, which says that a beneficiary in whose favour the trustee exercises the trustee's discretion shall be deemed to be presently entitled to the amount paid to the beneficiary or applied for the beneficiary's benefit by the trustee in the exercise of that discretion. So what that is meant to take into account is scenarios where the trustee has paid something to the beneficiary or applied it for their benefit. Paying for school fees may be an example of that, or paying for some expenses, but hasn't actually made a resolution to distribute that income to the beneficiary. So if we have an amount that can be shown to be income and it can be shown that it was paid to the beneficiary, then section 101 will deem us to be presently entitled regardless of the fact of whether the trustee has actually made us presently entitled by resolution. I guess the other area that needs to be covered is section 95A1, or the other sort of scenario is where we make somebody presently entitled and then we actually pay them the cash or we apply it for their benefit. And the question then, well, within the legislation, are we still presently entitled for the purposes of section 97? The short answer is yes, due to the effect of 95A1, which says that if we make a beneficiary presently entitled, that beneficiary remains presently entitled regardless of the fact of whether we've actually paid them the cash or not for tax purposes and for the purposes of section 97. There is also a further provision in 95A2, which says that if we have a vested and indefeasible interest in any of the income of the trust estate but are not presently entitled, the beneficiary shall be deemed to be presently entitled. So again, continuing on from that sort of scenario where for whatever reason income has been given to the beneficiary but we don't have a resolution saying that they're presently entitled, we can't avoid tax that way. 95A2 will catch us and deem us to be presently entitled for the purposes of section 97. In terms of timing of when we need to be presently entitled by, we turn to the cases for that, and one of the cases to turn to is Colonial First State Investments and the Federal Commissioner of Taxation. And it says that a beneficiary can only be presently entitled to income which the trustee has appointed in the beneficiary's favour prior to the year end. So what that means, obviously, is that if we want to make sure that our beneficiaries are presently entitled and our beneficiaries are paying the tax rather than a trustee, we need to be making our resolutions prior to the year end. One point on that is, again, we still need to go back and read our trust deeds. Most trust deeds will have in their income distribution clauses a requirement to have it distributed by the end of the financial year. However, I have seen on occasion deeds that set an earlier date, like 29 June or 28 June. So we do need to make sure that we do review the deeds so that when we're all sitting down in our boardrooms on the 30th of June and all our clients are coming in to sign their trustee resolutions on that day, that we're getting to make sure that we're doing it before the end of the year in accordance with the trust deed. The other part of section 97, which is a core concept and which has been subject to a lot of litigation over time, is what is actually income of the trust estate. So if I'll just go back to why that's particularly relevant in section 97. But if we see it there, it's in that second highlighting. So we have present entitlement, and we're entitled to a share of the income of the trust estate. So what is the actual income of the trust estate then? Again, it's not defined within the legislation. In Bamford's case, which is the most recent, although it's a few years ago now, most recent case in terms of analysis of Section 97 in this concept, says that it's given the ordinary meaning by the general law of trusts and the trust deed. So what that's saying is that, in effect, our income of the trust estate is what our trust deed says the income is. So if our if our trust deed says income is income in accordance with Section 95 of the Income Tax Act, then that's what our income of the trust estate is. If our trust deed has a different definition of what income is, then that's income of the trust estate. And that's the beginning of where we start to see some difference and confusion, and we start to see some of the issues, because they are different concepts. Our trust deed and our trust rules can effectively decide what is the income of the trust estate, separate to what the Tax Act say. And quite often there will be differences there, and we'll come back to those. But here we see the beginning of the sort of difference within the section as to what income we're talking about. So in this scenario, we're talking about income of the trust estate. Totledge's case tells us that it's the net amount after subtracting all expenses on revenue account from income on revenue account. But again, you'll hear that we often say this, and we never get sick of saying it. You do need to read the deed, because the deed will tell you what income is in accordance with the trust, or should do. Some deeds don't. On that point, most deeds from about the 90s will adopt the Section 95 income definition. However, if you have a deed that's older than that, you should definitely have a look at it. I mean, you should have a look at all of them to make sure. But if it's earlier than the 90s, definitely have a look at it to see how they define income, because you will see some strange and wonderful definitions of income there if it's defined at all. The other concept which we've come to adopt within our trust deeds, and it comes from the cases, is this idea of distributable income. So as I mentioned before, sometimes you refer to it as trust law income, or income in accordance with the trust deed. We've come to settle it on this concept of the idea of being distributable income. So what we say is that a beneficiary can only be presently entitled to income which is legally, so according to the trust law, available for distribution to the beneficiary, even though at the relevant time it may not actually be in the trustee's hands for distribution. So we use that definition of how to define income within our Cleary Hoare deeds, so our discretionary trust deeds and our unit trust deeds. And the reason for using that definition is it tries to overcome some of the scenarios where we do have that differences between income in accordance for tax purposes, income in accordance with trust law purposes, and whether the funds are actually there to be distributed or not. So with that, in terms of how we work out what the distributable income is, there still can be some issues. So for example, what would happen if the expenses on our revenue account exceed income on revenue account, and there will be no distributable income? Well, then the reality is that under trust law, we cannot distribute anything because we have nothing to distribute. So in order to address that, there are ways that you can address that with things like income equalisation clauses, or things that make particular types of income accretion to the trust fund, so that we have an amount to distribute. Remembering that this is distributions for trust purposes, and that differs for distributions for tax purposes, because different amounts are taken into account for trust or income purposes, and we'll cover that in later slides. To use an example, which we can flesh out as we move along, we've got our trust here, and if we have our definition of income in accordance with the trust estate to be distributable income, and in this scenario, we've ended up with $300,000 of distributable income. We decide to give Sally $120,000, Peter $65,000, and Bucket Co $115,000. We've broken that down into the percentages below of the distributable income. So Sally's part is 40%, Peter's is 22%, and Bucket Co's is 38%. And so that's just to show what percentage they're actually receiving of the distributable income, being the income in accordance with trust law purposes. So moving forward through Section 97, you may remember that another part of the Section 97 talks about so much of that share. So without going back to that earlier slide, Section 97 sets out that a beneficiary is assessed on the same share of taxable income as the distributable income. So if we receive so much of that share of trust law income, we receive the same share of taxable income. The question then is, if there is a later amendment to that income, whether that's because a deduction is disallowed or whether an amount of income is brought into the trust estate and we have an amended assessment, what happens to that extra income? And up until Bamford's case, there was often debate about whether it goes out in accordance with a quantum view or a proportionate view. Probably the best way to describe that would be to come back to this slide here. Under a quantum view, we would say that if we had a later amendment which increased the income, Bucket, Sally and Peter, they would still only receive 120,000, 115,000, 65,000. So they receive so much of that they've been distributed to, and then whatever the extra amount is would go somewhere else. And more often than not, that would go via a default distribution because there's no other beneficiary entitled. So obviously that's advantageous for the taxpayer in terms of providing certainty that this is the amount that we will always receive, the 115,000, 120,000 or the 65,000. The opposite approach to that is the proportionate view, which says that, well, the extra income that we receive gets distributed in accordance with our proportion of our trust law income. So if, for example, we had an extra $100 of income, and we will run through an example a bit later on in some of the slides, but just while we're on this one, as Sally received 40% of the trust law income, she would receive 40% of the extra $100, so an extra $40 and so forth. So the proportionate view was found to prevail initially in cases such as Zeta Force and then later on in Bamford, where it was decided by the courts that if there is a later amendment and there is a difference between tax law income and distributable income, then the extra amounts flow proportionally in accordance with the initial resolution. So there have been some, I wouldn't say changes since then, but the proportionate view is the one that we need to consider when we're drafting our trust resolutions, recognizing that if there is a change later on, then it will go to those beneficiaries in those proportions. The other concept within Section 97 is net income of the trust estate. So under Section 95, net income in relation to a trust estate means the total assessable income of the trust estate calculated under the Act as if the trustee were a taxpayer and were a resident, less all allowable deductions, except some deductions which are excluded. So that's why you often see deeds trying to align income of the trust estate to be, or define income of the trust estate to be Section 95, because in that attempt we can try to make sure that our distributable income is the same as our tax law income. In terms of the differences between the two, there can be, and here are some examples of why some differences can arise between the two. So we may have something that is a non-deductible expense for tax purposes, but is for trust law purposes. So for example, the entertainment expenses. We're taking our clients out to lunch. It can be a deduction under the concepts of trust law, however, is not for tax purposes. So there will be a difference there in between the distributable income or the trust law income and the tax income under Section 95. Also some different timing differences, but for depreciation, employee entitlements, those sorts of things. So to carry on with the way that the law is after Bamford, and continue on with our example, we had a distributable income that we'd made a resolution of, and we distributed of our 300,000 of distributable income to Bucket Co, Sally and Peter. However, in accordance with Section 95, our net income for tax purposes is 340,000. So the balance will flow proportionally to our three beneficiaries. So instead of receiving the 115,000, for example, Bucket Co receives 130,000, Sally 136 rather than 120,000. Where we can have issues with this, where there are these differences, are things like where we're distributing to minor beneficiaries from inter vivos trusts, because if we exceed approximately $600 in taxable income for those beneficiaries, then we're taxed at the top marginal rate, or where we're dealing with streaming. So we're wanting to make sure that, let's say, dividend income goes to one beneficiary and capital gains goes to a beneficiary that can get the most benefit from those capital gains. And we'll cover streaming later on in the presentation. The other thing that we can consider in our resolutions is what's known as a variation of income clause, and you would have seen these, where at the end we have a clause that says, well, if the Commissioner disallows, I'm paraphrasing here, if the Commissioner disallows a deduction or includes more assessable income, then there is a distribution to XYZ Co of that amount. That was examined recently in the case of Lusky, where the taxpayer's position, surprisingly enough, was where they had a resolution along these lines, and the resolution said that if the Commissioner disallows it, income will go to a particular company. In that matter, Commissioner later disallowed some things, and there was extra income. So the question was that resolution effective to send that distribution to that other beneficiary, or do the amounts flow out in accordance with the percentages contained in the resolution under the proportionate approach to the other beneficiaries? The court found in Lusky's favour, in the taxpayer's favour in that matter, and they said that the resolution was effective for those purposes, and it was a contingent resolution, that it was contingent on the Commissioner amending the assessment, and then it would flow to the company, the extra amounts. So they can be effective. However, the court was clear in that the trust deed needs to allow these sorts of resolutions. So we need a wide power to draft resolutions and to make resolutions. So it is something that we can consider for clients and we can implement for clients as a bit of a catch-all. However, we obviously, as usual, need to go back and read the deed. Coming to streaming, so we had the changes that came through some years ago now, and it was following Bamford's case. And we had legislative change implementations for some specific provisions to deal with the streaming of capital gains and franked dividends. They are, for the most part, relatively similar in their concepts and the way that they deal with capital gains and franked dividends. However, there are some differences which we'll go through. I will say they're very clunky in the way that they've been drafted. That's not the greatest drafting. I did have the chance once to speak to the author from Treasury for these sections. He apologised and said that they were rushed in with the idea that Division 6 would be rewritten shortly. Of course, that still hasn't happened. That's some 10 years ago. So with that, the first thing to remember is that the legislation doesn't give trustees a power to stream. So we still need a power within the trust deed for the trustee to stream income and stream different types of income. So the sorts of powers we would want to be looking for are powers to differently categorise income, put them in different accounts, deal with income separately. If we don't have those powers, then we can't stream. And you will find with some of the older deeds, the powers aren't in there. So we do need to review the deeds to make sure that we've got the power to do the things that we want if we have a trust that is dealing in capital gains or franked dividends. So in that situation, we would need to vary the deed to bring in these extra powers. Streaming of capital gains is contained in subdivision 115C, and streaming of franked dividends is contained in subdivision 207. There are some new terms that are introduced, which we'll run through in terms of streaming and how it impacts on our resolutions. So we have this idea of specifically entitled, as I mentioned before, a concept that the beneficiary must receive or reasonably be expected to receive, and this idea of a net financial benefit. And we'll examine each of those terms as we work our way through. The definition of specifically entitled applies to both capital gains and franked dividends. And there's two requirements. The first of is that the beneficiary must receive or reasonably be expected to receive an amount equal to the net financial benefit referable to the capital gain or franked distribution. So it doesn't have to be the same amount, as in if it's $50 received from a capital gain, we have to receive $50. We don't have to receive the same $50 that came from the capital gain, but we do have to either receive or be expected to receive that amount or that net financial benefit. The second part is that it must be recorded in its character as such in the accounts or records of the trust. So that's coming back to our power to stream and our power for our trustee to separately record income of different characters within the accounts or records of the trust. So that's how we become specifically entitled. In terms of that, there were those two other definitions there: receive or reasonably be expected to receive. So we must receive an amount equal to the share of the net financial benefit. So as we mentioned here on the slide, it doesn't require an equitable tracing. So again, that concept of it doesn't have to be the actual $50 we received on the capital gain, as long as we receive the same financial benefit, the $50. And it can also be expressed as a formula, even though the result of the formula is calculated later. So say, for example, A receives 50% of the capital gain and B receives the other 50%. Well, obviously, we don't have an exact amount there, but that will be enough for us to meet that definition of either receiving or reasonably be expected to receive. So the difference between the two, of course, receive, we actually receive the cash or the net financial benefit. Reasonably be expected to receive is where we have a distribution to us, which creates that entitlement, but we may not have actually received that net financial benefit yet. And other examples of that, if it was set aside. So the idea of this, the second part, is where it's meant to cover situations where, for example, a contract for a sale of land is signed in 1 year and settles the next. At the end of the year, we can make our beneficiary presently entitled and specifically entitled to the capital gain, even though we actually haven't received the financial benefit yet, because it's reasonable to expect that they will receive it once that comes into the trust funds. Net financial benefit is defined within, and it's the financial benefit or actual proceeds of the trust reduced by trust losses or expenses. So to run through a very simple example with Peter, a trust sells an asset for a gain of $1 million. The previous capital loss of $500,000 is applied against the gain, so our net financial benefit is $500,000. So we need to make sure that Peter receives $500,000 of net financial benefit from the trust in order for him to be specifically entitled in that example. You may recall one of the other requirements of being specifically entitled was that it was referable to the capital gain or frank distribution. Again, there are some definitions within the sections which outline how this occurs. So for a capital gain, it's trust proceeds reduced by losses. For frank distribution, it's the amount of the frank distribution reduced by directly relevant expenses. So what that means in directly relevant expenses, to use an example, if we borrowed to acquire some ASX shares, the interest that we would pay on the ASX shares is a directly relevant expense, which can be applied against the frank distribution under the streaming provisions. So that's the amount of the frank distribution that we would then need to make somebody specifically entitled to. One thing to remember, if we're dealing generally with internal transactions and matters involving restructures of clients where we have something that ends up with the market value substitution rule applying. So where we're not dealing at arm's length or we're not paying full consideration for an asset and there's a CGT event, the market value substitution rule substitutes the market value for our CGT event at both ends in terms of the gain and then in the cost base in the new entity. So with that, our streaming provisions do not apply to gains involving the market value substitution rule, and that's actually provided within the legislation. So the sort of area where we could come unstuck there is that if we had, for example, an internal restructure and we wanted to stream our capital gains somewhere differently to our income, if that capital gain is a result of the market value substitution rule, we couldn't. So it may be the case that instead of using or letting that apply, that we actually pay something so that then we don't have the market value substitution rule applying, or pay the market value, I should say. One of the other requirements in order to make sure somebody is specifically entitled and we can stream amounts is that it's recorded in its character. So again, turning to the legislation, it says it's referable to the capital gain or frank distribution in the accounts or records of the trust. And the evidence of that recording will be in the trust deed, resolutions, distribution statements. If we just have it in the tax return only, that's not going to be sufficient. So hence coming back to making sure that our resolutions, where we're wanting to stream capital gains or frank dividends, are up to scratch in relation to our records. Now, I did say before, timing of our resolutions have to be by the end of the year and in accordance with what our trust deed says. There is a slight difference with this, with streaming legislation, in that for dividends, we still need to make our resolution by the end of the year. But for streaming capital gains and making them effective for capital gains tax purposes, it's within 2 months of the end of the income year. However, we do remind everybody that that only applies to streaming resolutions. And what does our deed say? If our deed says that if we don't make a resolution by a particular date, then it goes to B, then that's what's going to happen in accordance with our deed. The sort of concessionary treatment of allowing us to make a resolution up to 2 months after the end of the income year, I think you're getting more trouble than otherwise than just making sure that we make our resolution before the end of the year. Because if you remember, in terms of capital gains, we can make it formula-based. So even if we don't have the exact figures at that time, we can still make our resolution within time. So what happens if we get it wrong? What if we're trying to stream something and we don't do it in accordance with the legislation? So an example for this may be that we have in our trust, we have some income from business activities and we have a capital gain. We want to send our income from business activities to a company and we want to send our capital gain to a person, so we get access to the discount capital gain and the 50% discount. So we'll need to stream in that scenario. We'll need to make sure our resolution is streaming those two different types of income and that we're making somebody specifically entitled. If we get it wrong, the amounts then flow out proportionally. So if we have a capital gain or a franked dividend to which no beneficiary is specifically entitled or only partially specifically entitled, that comes out proportionally. Doesn't come out proportionally in accordance with our share of trust income as it would normally in accordance with Bamford. It comes out in accordance with what's called our adjusted division 6 percentage. Adjusted division 6 percentage is our present entitlement to trust income excluding any capital gains or franked dividends to which they are specifically entitled over income of the trust excluding any capital gains or franked distributions to which any entity is specifically entitled. Formula-based approach is probably easiest to go through it via an example in terms to show that how it would work with our adjusted division 6 percentage. But generally speaking, if we get it wrong and we're looking to stream, there will be some unintended nasty tax consequences. So to run through an example to show what would happen if we got it wrong, in our facts, we have a section 95 deed. So it's a deed that says income is income in accordance with section 95. Under our resolution, we have the trustee resolves to distribute $50,000 being the net capital gain on the sale of shares to Peter and $100,000 of income to Bucket Co. So what would have happened in that situation is we would have had a sale of shares by Peter by the trustee, sale of shares by the trustee for $100,000. They've applied the discount in accordance with section 95 because that's what our trust deed says we have to do, which would leave us with $50,000 of income in accordance with section 95, and they've distributed that $50,000 to Peter, and then the other $100,000 of income to Bucket Co. So if we work our way through the legislation, Peter is only specifically entitled to $50,000. He's only entitled to the $50,000 that was distributed to him as a component of net income. So after the discount was applied by the trustee. This leaves us with $50,000 floating around, not specifically entitled. Now, before the streaming provisions were brought in, not so much of an issue because we could make an argument that that flows through to Peter and it's grossed up in his hands and then reduced again. However, now that the streaming provisions are within the legislation, the fact that Peter is not specifically, or anybody is specifically entitled to that $50,000 means that we need to go back to our adjusted division 6 percentage and flow it out from there. So in terms of Peter, his adjusted division 6 percentage would be 0 because 0 divided by anything is always going to be 0, according to my grade 3 maths. So that leaves assessable income of $50,000 to Peter, which would be reduced to $25,000 by the discount gain. So he still gets that $50,000 of income from the capital gain, but he doesn't get any of the extra 50,000. That extra 50,000 in effect flows out to Bucket Co. Its adjusted Division 6 percentage would be 100,000 over 100,000, so 100% in our example. So at the end of the day, Bucket Co.'s tax would be the $100,000 of income it receives separately, so the normal ordinary income, and then $50,000 of capital gain. We know a company can't access the discount capital gain, so the company is going to get taxed on that full $50,000. Our clients are not going to be particularly happy in that scenario that we haven't got our streaming resolution correct. So assuming a 30% tax rate, can't apply the discount. We end up with an overall tax bill of $45,000, which is $15,000 more than it should have been if we'd got our streaming resolutions correct. What would we have needed to have done in that circumstance? The distributable income is Section 95. So as I said, that reduces the income in the hands of the trust to $50,000 being the net income. So we would have to distribute that $50,000 to Peter using the income distribution clauses. Then we would have to make a distribution of $50,000 of capital relating to that extra amount, the difference between $50,000 and $100,000, to Peter as well. That way he would be specifically entitled to the entire net financial benefit, the entire $100,000. So then we would have successfully streamed. We wouldn't need to rely on the adjusted Division 6 percentage because there are no beneficiaries not specifically entitled to a capital gain or a dividend. And we would end up with the tax result that we wanted. And of course, the other part of our resolution would be a distribution of $100,000 to Bucket Co. One question to think about, well, what if we didn't have a Section 95 deed? What if it was silent, or it didn't, well, obviously it didn't say that income is income in accordance with Section 95. What we would have to do in that circumstance to make sure that we can stream that amount to Peter and get access to the discount capital gain was we would distribute $100,000 of capital relating to the profit on the sale of shares to Peter, because under normal trust law, a capital gain is not income. It's only turned into income by Section 95. And then we would distribute $100,000 to Bucket Co. And that's the way that we would approach that if for whatever reason we had a deed that didn't allow you to define income in accordance with Section 95. A few years ago, we developed this trust streaming flowchart. I guess the first question to ask ourselves would be, does the net income include capital gains or franked dividends? If it's no, then streaming provisions aren't relevant. We don't need to worry about them. If it's yes, then obviously we do need to think about this concept of specific entitlement. First question, is there specific entitlement? No, then really the streaming provisions aren't relevant. And by that I mean we're not streaming. We're going to be having everything adjusted by Division 6 percentage. So we're not achieving our objectives. If yes, then we need to make sure that it's all specifically entitled. If that answer is no, if that's not all of the dividends or all of the gains specifically entitled, then we would have a component of specific entitlements and adjusted Division 6 percentage. If it's yes, then we're streaming properly and we're making sure that our assessable income is ending up where we want it to be. So in the case of our example, the capital gain in the hands of Peter, the entire capital gain, so he can use the discount capital gain, and the income in our company, so it's taxed at the company tax rate. In order to draft effective resolutions, and we will run through a resolution over the next few slides, obviously first off we need to read the deed. We can't rely on templates. I know there are templates out there provided by professional bodies, and some of them are very good, but we still need to read our deeds to make sure that we're, one, referring to the right provisions, our deeds have the right powers, all of those sorts of things. We should be able to identify our beneficiaries and why they are beneficiaries, identify the definition of income under the deed, refer to our character of income, refer to our power of the trustee to distribute income, refer them to separately categorise and record income where we're looking at streaming. Referring to the nature of the income is crucial in the wording of our resolutions. As we mentioned before, the formula-based approach is usually acceptable. Each deed provider, if you've used a number of deed providers over the years for your clients, there are slight variations there, and there are things that can catch you out. So as we mentioned, really no blanket precedents. You should be examining each trust deed and each client on their merits when we're drafting up our resolutions. I was having a discussion the other day I can't recall whether they registered for this session. So if they are, they'll know this discussion with an accountant who was saying that the resolutions that they were looking at that had been provided by their body were pages and pages of resolutions. In reality, that's the way that they should be. If we've got a nice simple matter where we're not looking to stream capital gains or dividends, and we're just dealing with a client that has a business income, then we have a nice simple resolution. Whenever we're going to get into streaming gains or dividends, then we're going to have a complex resolution, and it is going to run to pages and pages, or it should, because the cost of getting it wrong, as we've seen in our simple example, it can be a fair amount to the client. So over these next few slides, we've got an example of the sorts of things that we would need to put in a resolution. So here we've got a resolution of Trustee Co. as trustee of the Smith Trust. First off, partway down the page, we're confirming who are the beneficiaries. Now, these are the people that are going to receive the income. So we're making sure we're outlining how they are beneficiaries. We're determining our income. So a trustee is either making a determination or making a determination of how to determine income, depending on what our deed says. This is based on the Cleary Hoare deed, so those particular clause references relate to it. We would then make a distribution of, or decide to make a distribution of income. So in order for that to occur, the first step would be to make sure that we will make a determination that we're going to distribute we're pointing out our powers to distribute and pointing out our powers to distribute capital under the resolution. So we're referencing those powers and saying we have a power to distribute income under this clause and a power to distribute capital under this clause. We're pointing out our power to separately categorise. Remembering, unless our trust deed has the power to do this, we can't stream different types of income if they're capital gains or franked dividends. So we need to make sure that we point out what our power is to do so. And it's a good thing to do, because then we know that we have that power, as opposed to having to go then vary our trust before the end of the financial year. Resolving to create those separate accounts, so record our income separately. Distributing our capital gain would be our next part of our resolution. So here we've got our distributing our capital gain, distribution of franked dividends, distribution of distributable income, or the balance that's left after we're dealing with our capital gain and our franked dividends. So having separate sections for each, and then closing off the resolution. So obviously all of those things are not going to be relevant to every client, but it's a good idea obviously to work through and keep those different things separate in terms of those different types of income, so that we can make sure that we're streaming effectively for both capital gains and franked dividends. If you have trust deeds in your stable for clients, we do offer a service where we will review that deed and vary it if changes are required, so that we can stream capital gains or franked dividends. On that, as I said, if deeds are principally since the 90s or mid-90s, normally they will be okay and they will have these powers. Of course, you can't just assume they will be. But definitely with those older deeds, you should have somebody have a look at them. And we do also have a service, I guess you could say, where we can provide you with some template letters to provide to clients to say that we want to engage Cleary Hoare to review your deed, say yes or no. So that's a bit of a behind covering on your end. If they come back and they say no, and the deed's found to be later to be deficient. As I said, we charge to review the deeds, automatically vary it, and there'll be additional fees. But if you're interested in developing something like that, just contact the office and we can organise that. Any questions?
Thank you, Adrian. There aren't any questions at the moment, but if anyone wants to chime through with a question on the chat line, please do so. We will stop the recording, so if you feel more